Let's turn our attention back to the roller coaster ride that is the crypto corner. Seems like a daily conversation now here. We saw that big sell-off brought on by regulation concerns, both here in the U.S. and China, but Bitcoin climbing back up above that $37,000 handle today. Ethereum also seeing a bounce back in the session after falling to around 1750 price point on Sunday. Now, some of the rebound we're seeing today helped by a research note out from Goldman Sachs saying Bitcoin is now considered an investable asset. Also, Bridgewater Associates founder Ray Dalio revealing he has taken a position in Bitcoin as well. Let's bring in Garry Tan, Initialized Capital founder and managing partner. Garry, always good to talk to you, especially in the face of some of these volatile moves. I'm curious to just get your thoughts on some of the moves we've seen on the back of these headlines coming out of China. Number one, in a broader crackdown on Bitcoin, which has been in place since 2017, but more recently, that headline coming out on Friday about cracking down on Bitcoin mining.
Yeah, I think that there's some evidence from the mini crash from this weekend around this Chinese regulation on Bitcoin mining activity. And mining is heavily concentrated in China. So one of the things that I've been really tracking on my end is the fact that Ethereum is going to a 2.0 version using proof of stake. So what that means is that instead of using proof of work, which requires an incredible outlay of both capital and energy resources, as Elon Musk pointed out. Ethereum 2.0 is actually going to bring that energy use down by 99%. So it's really just far more efficient. And not only that, the fees that go to miners are actually going to go to people who are staking their ether into the security of the network. So I think that that's going to be a really big shift. I think regulation will continue to evolve over the coming years and months because I think that you're going to see countries like China, perhaps even the United States, consider this technology is not going away. It's durable. It's valuable. And so we want a part of that.
You've highlighted, of course, that a drawdown of 50% or more has happened 6 times before. If you couldn't necessarily stomach the volatility, you wouldn't be invested here. But I wonder what you make of what we have seen over the last week or so in terms of what that says about how much more there is to fall, or whether there is, like you said, another leg up here on catalysts like the energy concerns.
Yeah, I think the big thing for people who are new to crypto right now is that these sort of drawdowns are actually quite common. And I would say that if you look at what the terminology and the memes coming out of the GameStop world of diamond hands, a lot of the people who came up with those terms, they came out of the crypto world. That you have to basically hold on if you believe that the fundamentals of what you're holding continue to hold, even despite a 20 or 50% move. And I think that that's just really, really key for people who are freaking out right now. I totally understand that. And the strangest thing that I've learned about crypto over 5 or 6 of these cycles at this point, I guess this being the 7th, the best time to buy, if you have a very clear thesis about the use case for these things, is actually when there's maximum pain. And so it's incredibly counterintuitive, but I think that's really bled over to how a lot of people are approaching. Earlier you were referring to meme stocks, so it's interesting to see the crypto culture really bleed over to the stock culture.
Garry, last time we talked to you was on the public debut of CoinBase, which, of course, you invested early on. The stock is up today, but, of course, that's kind of traded in tandem with Bitcoin. You mentioned then that it is sort of the Microsoft or early days of Microsoft. It's sort of how you view it right now. A lot of concerns right now about the transaction fee and how reliant the company is, but also some of the competition it now faces from decentralized exchanges. I know it's been only a month or so, but I'm curious how you've been watching the moves and how Coinbase has been trading.
Yeah, I think one way to really look at Coinbase is actually sort of highlighted by my interview on my YouTube channel with Brian Armstrong, the CEO and founder. He ended that interview with a thing that really jumped out at me. He said, "We're at 1% along the way of the journey." And to piggyback on Microsoft, Microsoft has been able to build not just one but several incredible cash cows on that initial base case, which was actually ability to own MS DOS on the IBM PC. After that you had Windows. After that you had Office, and I think that you're going to see similar, really evolution for the Coinbase business. Just a moment ago we were talking about the future of proof of stake cryptocurrencies. Other really promising cryptocurrencies that have reached mainnet and are in broad use today include Avalanche token and Solana. I'm paying a lot of attention to those today because proof of stake is the future. And Coinbase, for instance, right before the IPO, actually bought a portfolio company of ours called Bison Trails. And so Bison Trails is turning into the gold standard. If you're a corporation that needs to run a proof of stake node to secure your network, this is really the hosting provider, the most trusted hosting provider. And so looking at some of the other tech giants, if you look at Amazon built one of the most profitable businesses on the planet off of Amazon Web Services. And that was really empowered by their initial sort of toehold and their initial growth from book sales. And so that's sort of the thing that I think will continue to occur with a company like Coinbase. Your initial foothold might be exchange, but when you're talking about a platform that will end up being the on-ramp, the identity, the safe place with compliance, with insured assets, these are all sort of the necessary steps to having the crypto ecosystem that actually touches all the parts of the real world. And that's what put Coinbase into business. That's what Coinbase will use to actually continue to build this crypto ecosystem. I think speculation on the Bitcoin price or the price of various tokens, that's really just noise to me. It's really about the use cases over the next 10 to 20 years.
Garry, obviously, you work very closely with a lot of startups as they look to sort of build out the company and look at their potential path to going public. SPACs have been a very popular way over the last year, but it does feel like the wind has sort of been taken out here, largely because of the SEC increasing its scrutiny on it. A number of EV companies, for example, getting a lot of scrutiny, being investigated now. Is that still a path that you advise for some of the startups that you work closely with, or is that something that you think maybe is one option that's been taken off the table, just given the uncertainty around it?
I think what's really important for retail, but also institutional investors to think about when they're looking at SPACs is who is bringing these SPACs to the world. And I think the public market doesn't get going public correct every single time. Very obvious example of this to me is look at Blue Apron versus HelloFresh. I mean, Blue Apron was blessed by quote unquote the capital stack. A lot of really, really prominent growth investors sort of blessed that as the clear winner in the space. And what I've learned as a very early stage investor, having invested in this space, is that often the one that is blessed by the capital stack, actually, it's the Blue Apron, right? And Blue Apron never had great economics. I think that there's sort of a sense that if you get the right investors on the way up in the private markets, you might be able to be blessed, but that's bad for the ultimate investor. And so I think the SPAC is actually a very interesting tool for things that we're not necessarily blessed by the powers that be. Who says who gets to IPO, and I think that in the end, a lot of these SPACs are really not going to make it. On the other hand, enough will build durable businesses that I'm pretty excited, and I'm still relatively bullish. But you really got to look at who is putting these SPACs together, what's the reputational risk, and I think as that develops, we're going to see more activity and more things that we're actually going to be happy that we have invested in.
How many of those SPACs do you think get filtered out when you talk about sort of being a little more selective? It sounds like you think it's still an attractive option for these companies.
I think it really just depends on how much money you can actually raise, and are you ready to be public? And there are a great number of companies that might actually be ready, that could actually become profitable. And the SPAC in the pipe option is turning out to be attractive if your competitors that might be the Blue Apron have raised too much money. And I think that that's one pattern that we're starting to track.
We are seeing the yield on the 10-year Treasury notes are pulling back just in the session right now, about 1.6%. Inflation fears still continuing to rattle investors in the market with PCE data, of course, personal consumption expenditures out on Friday. Let's bring in James Bullard. He is, of course, the St. Louis Fed Reserve President. We've also got our very own Brian Cheung joining in on the conversation. President Bullard, it's good to talk to you today. When you look back at the more recent economic data, it really did feel like the CPI number that came out a few weeks ago kind of spooked the market. We've also seen what was really a disappointing jobs number back in April. Walk me through how you're interpreting the data right now as you connect the dots.
Well, I think we are going to see more inflation. That's not really a surprise. I think that maybe the size of that particular report, but that's just one number. So we'll see if the demand really flows through to a lasting increase in inflation, or if this is just temporary. I think it's mostly temporary, but that some of it will flow through to inflation expectations, and that we will get inflation above 2% this year and into 2022.
Hey, Jim, Brian Cheung here. Great to speak with you. Now, we've heard from some of your other colleagues in Dallas and Philadelphia, namely saying that they would like to talk about tapering sooner rather than later. Inflation might be one of the reasons there. And you had a very colorful quote in an appearance last week. You said, there's a little bit of an inflation hawk in all of us. If there's an inflation hawk inside you, what is that hawk maybe saying about when is the right time to have those discussions?
Yeah, I mean, I think the inflation hawk aspect is that the big inflation that we saw in the 70s and 80s was very painful for the U.S., and it took a long time to get rid of it. So all the way into the 1990s. So no one wants to replay that experience. But the modern era that we're in now has been characterized by inflation, which is too low relative to our inflation target. And so we're just trying to move inflation a little above target and approach inflation from our inflation target from the high side instead of from the low side, which is where we've been over the last 10 years. You've also got Japan and Europe mired in negative interest rates. We'd rather stay out of that game.
So it sounds like from that perspective, you're not too worried about having that tapered discussion soon, but do you see maybe a case for modifying the $120 billion a month pace? There's been some suggestion that with the housing market looking hot, maybe you could twist away from mortgage-backed securities and lean more heavily on the U.S. Treasury side of purchases. What do you think about that?
I think there will come a time when we can talk more about changing the parameters of monetary policy. I don't think we should do it when we're still in the pandemic. And I know we're getting closer and closer to the end here with more and more vaccinations every day. And so I think it's tempting to feel like, financial markets always want to look ahead, and that makes perfect sense. They have to price all these assets. But when you're in a crisis, I think you should make sure that you've exited the crisis aspect before you think about changing policy. We're not quite there yet. I think we will get there in the months ahead, and that'll be the time when we can start thinking about altering our asset purchase policy.
So what does that say about your view on the labor market? We know that there's still over 8 million relative to pre-pandemic levels still out of jobs, but would you call it a labor shortage? Because our conversation with the San Francisco Fed president, Mary Daly, she said, don't call it that because it's a very interesting dynamic at play. What's the major reason, the top one, based off of what you're seeing in and around St. Louis, for people not coming back to the jobs that appear to be out there?
Yeah, the anecdotal evidence is overwhelming that this is a tight labor market, and I think we should look at measures which would corroborate that. Otherwise, you've got this glaring inconsistency between the way we're measuring the labor market and what people are actually saying about it. Firms are saying it's very difficult to hire workers right now. I think if you look at the unemployment to vacancy ratio, that's about a 1.2 today, almost one job opening for every officially unemployed worker. So that makes a lot of sense that it would be hard to find workers in that environment. So it's a much tighter labor market than other measures would suggest. And I think maybe we should look at the U over V as a metric for where we are in labor market tightness.
You also said recently that, when you look at the type of fiscal support that's been available from Congress, you think that the one-size-fits-all approach doesn't necessarily address the divide that we're seeing in the labor market between the rural markets as well as the urban markets, too. Can you talk a bit about how those recoveries are diverging right now, and what is the solution here to address that?
Well, the top off in the unemployment benefits from the federal government was certainly welcome, but these markets are very different. The rural labor market in Kentucky or Mississippi or rural Missouri here is very different from big cities like New York or San Francisco. And so the same numbers might mean different things in different places. So I'd really rather that Congress would calibrate that in a way that would be more attentive to the fact that these labor markets are different, and the pay scales are just different. So you're affecting individual incentives to come back to work differently in these different labor markets, and that's something that firms are very sensitive to. You've got small businesses that have been really down and out during the pandemic. They're now trying to come back in, get their revenue streams back up and running, and they can't find workers. That's a very frustrating thing. That's why we're hearing a lot about this. I'm certainly hearing a lot about this in recent weeks.
Well, this is a fascinating element, too, because part of workers, or rather employers not being able to find workers, is whether or not the incentives are matching what these types of people looking for jobs are really trying to get compensated for, especially with the risk of getting the virus still out there. So how are you interpreting wage data from that standpoint? We'll get another employment report covering the month of May next week. Is the data still really noisy, or are you really starting to see anecdotal evidence of wage pressures pushing up, which might actually pass over to overall price inflation as well?
Well, these individual businesses are pretty good at what they do, and so they try to get inventive about attracting workers. They might offer a one-time bonus to take the job. They might offer a bonus to take the job and stay in it for 30 days or 60 days or longer. And they might just go ahead and raise the wage that they're offering on the grounds that they'd probably raise it in the future anyway. So I think you are seeing some of the compensation be better, and certainly that's good news for workers. I think what you alluded to at the beginning of your question, though, is that for a disrupted worker who's at the low end of the wage scale, I'm not sure exactly today if it looks like a really good situation to go back to work, because you've still got residual risk on the pandemic itself, and so they're nervous about that. Maybe they wouldn't get paid all that much more than they used to, so they're maybe thinking it's not that great of a labor market yet. And also, these are very flexible markets where people come in and out all the time. So they might feel like they can just wait 30 days or 60 days or 90 days and these jobs will still be out there. So it's not like if I turn this one down, I won't be able to get another one in the future. I think that's probably not the case. They probably will be able to get those in the future. So from the worker's point of view, it's not clear that everyone wants to just jump back in all of a sudden here. There are plenty of reasons. I forgot to mention daycare. You've also got kids at home still. That's been a big factor through this. So it's not so clear for disrupted workers that they just want to stream back into the job market.
Broadly, I want to switch over to financial stability risks. A lot of questions about the impact of running monetary policy this hot for this long. Do you see any sort of bubbles from your vantage point?
We monitor financial stability very closely. I would say it's higher, instability risks are higher than normal, but still not at an alarming level. I think you'll get a case on all sides of this from people on Wall Street, but we are trying to be very careful, look this over very carefully, and take it on board as a potential risk for the U.S. economy.
How big of a risk does climate change rank when you look at the broader challenges to financial stability? The Fed's already set up these two committees to deal with the impact, but what do you see as the headline risk on the issue of climate?
I think we've moved into the mainstream of central banks by joining the international consortium on this. We're certainly cognizant of the financial stability risks related to climate change, but we're doing risk assessment all the time on all kinds of issues, not just the climate change issue. So this is one in a catalog of possible risk to financial stability going forward. And climate, of course, is a slow-moving object, and so the sense in which it would feed back to financial stability is tougher to trace than it would be for other types of financial stability risks that might be more observable, risky lending, for instance. So I think we have to take that into account. It's just a different type of risk than others that we have analyzed historically.
And Jim, we can't let you go without asking a question about cryptocurrency, especially given all the volatility in prices over the last week, or even before that, well before that. So what are your views on cryptocurrency, its use case right now? And then by extension, how closely have you been watching a lot of the volatility in crypto markets as it regards to the Fed's work on a possible digital dollar?
Yeah, I mean, how long do you have? I mean, I have a slide deck on this that's called Non-Uniform Currency and Exchange Rate Chaos. And a couple of the things that are in there. One is that currency competition is nothing new. Private currency issuance has been addressed historically in monetary theory. Milton Friedman said, if you allow private currency issuance, you'll get all kinds of private currencies being issued. And that's exactly what has happened. We have a couple thousand of these around. Most of them are worthless. Also, I think if the cryptocurrency can facilitate transactions that are difficult to make in conventional currencies, then they will have a purpose and might circulate alongside of the nation-backed currencies. So that's another thing I talk about there. They're also quite volatile, as has been very apparent here in recent days, but the fact that different currencies have volatile exchange rates, that's a fundamental problem in the international monetary order, and it's just that much bigger of a problem for privately issued currencies, but it's even a problem for nation-state type currencies where they trade in a volatile way against each other that seems to be distant from actual movements and fundamentals. So lots of interesting things going on in this space. And of course, the Fed is also looking at a Fed coin. So we've got a lot going on. We're watching this very carefully. And I guess that's in a nutshell, that's where I'm at on this.
Jim, I want to follow on what you just said about how maybe most of these are worthless. Then wouldn't that present sort of some financial stability risks if a lot of people are putting money into this thing and it has a value that goes up a lot? If they try to all liquidate at the same time, might that present some issues with a lot of financial institutions maybe getting involved as well?
Well, we hope that those that are involved know the risks attendant. Of course, anytime any investment that you do can go up, but it can go down as well. And so anybody that's putting a portfolio together has to balance the risk and reward, as always in finance. So I think for the most part, people are going into this with eyes wide open. They're certainly not blind to the idea that this is a volatile area, and I would just encourage everyone to be careful and take the risks on board when you're making any investment.
Some good words to end there. St. Louis Fed President James Bullard, it's great to talk to you.
Well, anyone that has tried to rent a car lately knows that even if you are lucky enough to find a car, you're going to be paying an arm and a leg for it. But there is a solution, and that is the Airbnb of car rentals, and that's called Turo. We're joined now by Andre Haddad, CEO of Turo. Andre, great to have you with us. As I just mentioned, Turo is a peer-to-peer platform for renting cars. Curious to know what kind of growth the company experienced over the last year, especially as these car rental companies have not been able to keep up with the demand that they've been seeing as more and more people have been taking those road trips and have started to travel again.
We're uniquely positioned to alleviate this rental car crunch because our hosts have already cars that they own, and they're already leveraging this underutilized asset, which is the car. As you know, cars are idle the vast majority of the time. So we're uniquely positioned to help alleviate this rental car crunch, which is making travel a lot harder for many people. And our hosts are telling us that their business is really booming thanks to the surge in travel, as well as the sky-high rental car prices. So we're super excited to see the hosts, building their businesses. We have many that have seen their earnings just multiplied by a factor of 10x between January and June of this year. So it's pretty amazing. We've got hosts in Hawaii in particular who are seeing incredible boom in their business, but it's frankly a phenomenon that we're seeing across the country. So we're just delighted to be able to provide an alternative for travelers and also an exciting opportunity for people to make money with their cars.
Yeah, I know that, Kristen, you had personal experience with this because you were in Hawaii recently, and I know that you were saying the rental cars were out of control, right? The prices for rental cars.
It was a lifesaver. It was a lifesaver, Alexis. Honestly, Andre, I'm so grateful that I discovered Turo because I don't know if I would have been able to afford going to Hawaii without that platform and without that service.
Well, wonderful to hear. Thank you for being a customer.
I've got a practical question, not having used your service. I'm just wondering how insurance works. I mean, if you have your car, sometimes you go, well, no, I don't want so-and-so to drive it. They're not on my insurance. Well, what do you do with a complete stranger using your car? And how do you know that they have a good driving record?
That's such a great question. It's like the first question people ask me when I tell them about Turo. So thanks for asking it. We solve the insurance questions. We with our partner Liberty Mutual, provide the insurance for our hosts and our guests. So you don't have to worry about your personal coverage. You don't have to talk to your insurance company if you're thinking of sharing your car. You just get the coverage directly from our partner Liberty Mutual here in the US and other partners around the world where we have business. And so it works like then normal insurance. So when the car is booked by one of your guests and they're driving it somewhere else, it's at that point in time where the Turo insurance policy covers both you, the host, and your guest. And, it takes precedence to your personal insurance coverage.
So, Andre, as you were mentioning, business is booming for you guys throughout this pandemic. And it is also booming for a lot of the hosts that are renting their cars. But what are you anticipating, as we were just discussing in the last segment, about how those daily case counts are dropping? More and more people are getting out there. I'm sure a lot of these rental car companies like Enterprise and Hertz are going to start buying back some of their cars to really make sure that their supply can meet demand. So what are you anticipating for Turo going forward once we really start coming out of this pandemic? Are there concerns that growth, that the demand is going to drop as folks perhaps head back to some of those big box car rental companies?
There's clearly, I think, a unique moment in time now with, the rental car crunch, the inability for the large fleet car operators like Enterprise and Avis and Hertz to scale up their fleet because of the shortage of cars and shortage of microchips. And, I think we've talked quite a bit about these issues on the show. So we do expect that situation to resolve itself over time, although we don't expect it to be resolved very quickly. We think that this situation is going to be challenging for the rental car giants for the next 6 to 18 months. So During that time, we're going to continue to position ourselves to be a great alternative and a great way for travelers to find other options that are more attractive. And frankly, we're super delighted to allow our hosts to drive their revenue and drive their earnings during that period of time. And what we do know is that once a guest has connected with one of our hosts, they become really loyal to the platform. They tend to use us time and time again. And so this is an exciting opportunity for our hosts to acquire a lot of new customers and then to make them return customers over the next many years. And so we're overall very optimistic about the future.
What about your business model, Andre, and your revenue stream? How are you making money? And when you think about innovating in your space, what are some things that we could look forward to at Turo?
The way our business model works is that since we intermediate the booking between the host and the guest, we charge a fee to both hosts and guests, and that's how we are able to build our business, build the platform, hire all the people that are building those innovations, that are handling, the customer service questions and emails and calls that we receive, and make it a successful, profitable business for us as well. And so that's how we monetize the business. In terms of innovations, we have a very exciting, philosophy around innovations in general, which is just trying to make it as easy as possible to earn money with your car when you're the car owner, as well as make it as easy as possible to get a car when you need one. And so we have a very exciting product pipeline ahead. Stay tuned for more announcements around the innovations, but the philosophy will not change. It's just going to make it super easy for hosts to start their business on Turo, as well as scale it and add a second or a third or fourth car, and then for guests to be able to find us across all of the destinations of their travel over the next many years.
I'm wondering if you're seeing what sort of the Airbnbs of the world have seen, which is you start out using your own car and renting that out. But then you start to actually buy other cars for the sole purpose of renting them out. We see people buying homes or apartments now for the whole sole purpose of renting them out on these peer-to-peer type programs. Are you starting to see that already in your space?
We absolutely have seen that. We've seen primarily a lot of our hosts who were interested in scaling their business to convince their mom or dad or brother or sister or friends or neighbors actually to give them responsibility for their car so that they can monetize it for them. A lot of people are interested in earning money with their vehicles, but may not be interested in actually becoming hosts themselves. So what they're doing is they become co-hosts. They provide the car to their neighbor or their brother or sister, and then they share their earnings. So that's been a great way for many of our hosts to scale up the number of cars that they can monetize on the platform without actually having to go out and buy any new cars. And then there is another step, which is even further when hosts are really interested in building a small business on the platform and they want to commit over the long term. Then they're actually going out and getting additional cars and are dedicating them 100% of the time to the usage on the platform. And that's been hugely successful for many of these hosts, in particular in Hawaii, that are able to alleviate that travel crunch that we're seeing in Hawaii.
Andre, really quickly, are you planning to follow in the same footsteps as Airbnb and potentially go public?
We have all the options ahead of us. We haven't made any decision at this point. We definitely believe that the business has a huge potential, whether it's privately owned or publicly owned. So we're open to the different opportunities that we have, and we're really focused at this point in making sure that our hosts are able to alleviate this rental car crunch as much as possible and earn as much money with their cars as much as possible, and provide travelers with as many good options as possible. So hopefully for your next trip to Hawaii, you'll continue to use us.
I do have to say, and I want to let everyone know, he did not make me say this. I actually did enjoy using Turo. I will absolutely use it again. So you can count me as one of those customers that will definitely be returning. Turo CEO Andre Haddad, thanks so much for joining us. We're joined now by Mark Mahaney, Senior Managing Director and Head of Internet Research at Evercore ISI. eye. Mark, looking at today's moves, we're seeing those reopening trades, those tech shares gaining today. What's the narrative for the rest of the year on some of those reopening moves?
Or maybe there are two or three cross currents. First is, are we in fact reopening? And we are. I guess the real debate is the rate of reopening. The second is the counter trend is the rise in inflation. And for tech stocks in particular, that's usually a material overhang or a headwind, especially with high multiple stocks, the PS crowd, the price to sales crowd that doesn't have earnings, that is valued by the market on price to sales. And so therefore the profits are in the long term and in the terminal value. If you raise inflation rates, that means you're going to have to discount those back at a higher rate. So that's why tech stocks underperform. So that's the second cross current that we're looking for. And maybe the third one in the market overall is just regulation and the concerns over rising regulation, not for most of tech, but certainly for the mega cap names, the Apples, the Amazons, Facebook, and Googles.
Hey, Mark, I'd like to get your thoughts on some news crossing the wire here. Again, it's people familiar with the matter, so neither company is confirming anything, but Amazon said to be nearing a deal to buy the Hollywood studio MGM for $9 billion. Do you think that that's a smart move? And what's that going to mean for, for the other streaming services that are out there if Amazon, with its muscle, which already has Prime, gets into the Hollywood business in this way?
Well, I think you're going to add a fourth major. You already have four major players in the space. Let's do Netflix. Let's do Disney, the Discovery merger, and now Amazon. And Amazon's been in there for a while. I'm sorry, we should have five because we got to have Google with YouTube. They're not necessarily a streaming company the way that most people think about a paid subscription service, although they do offer that. But they are a free streaming service that provides entertainment to a lot of people. So what it's a sign of is just how competitive this space is. So there's the cost of entry, the cost of participation in this club is going to rise. Over the last 2 years, you've had a surge in new streaming services. I think there's going to be consolidation. I'm not even sure those five will all stick it out, but it's the table stakes here are extremely high. You have to be willing to spend probably $10 billion a year in order to be a global streaming company. And I think very few companies can afford to do that beyond those five.
So if we're going to see consolidation, which a lot of people have been saying for a long time, they all can't survive and do well alone. Who do you think we're going to see pair up? And what's that going to mean for us customers? Because I don't know about you, Mark, but I'm getting pretty confused. There are just so many services out there, and my bill is about to be more than it was with cable.
Well, I think one thing that's happened is linear TV. We're seeing the slow, gradual, or maybe rapid decline of linear TV. What's replacing linear TV isn't Netflix. What's replacing it is the streaming bundle. Recent survey work that we did, and it's consistent with what some other surveys that are out there. The average U.S. household subscribes to 3 paid streaming services. I don't think they'll ever subscribe to 5 or 6 or 7. It's possible, and some people certainly will, but they're not going to just subscribe to 1 or 2. So there are going to be a few winners in here. There'll be a few very large winners in here, but it's only a handful. Again, there's probably about 5 names. And so we've had a launch of a slew of other services. I'm not sure they'll consolidate. My guess is that you'll see some just go out of business and they'll just get back into not trying to build up a direct-to-consumer service business, but selling their content to those 5 big players, the people that are cutting those checks for $100 million for an episode or for a series. I think that's the real consolidation we're going to see, and it's mostly going to be the services that have launched. There's probably too many out there. You're going to have some that just shut their doors.
Curious to know, Mark, what you make of the entire communication services sector, especially as we see this consolidation in this space. Are you liking that as a sector moving forward?
Well, there's a lot of names in there, so I'll just stick with one that we do like. I mean, we like Amazon as a stock. It's our number 1 mega cap name. Not so much for the MGM deal. And the question was asked whether it's a smart deal or not. I'm actually not sure if it is. It's just that $9 billion is a lot of money to everybody else except for Amazon. And so they can, given their cash generation of the company, they can easily afford that. And it's not like it's a completely orthogonal move. It is consistent with what they've done in the past in terms of building out the streaming business. But I like Netflix just as a standalone streaming asset. It's the global leader. They consistently show up in our surveys as having the best content. And they've done a really good job of going far beyond the market. They're probably 2 years ahead of everybody else in terms of building out original local language content, not in the U.S., not North America, but in the Philippines, in Thailand, in India, in Poland, and Turkey. That's really where all the sub growth is. 90% of the global streaming sub growth is outside of North America, and I think Netflix is better established there than the other companies. So I actually like Netflix as this play off of streaming video.
Hey, Mark, what's your take on cryptos? Do you have any exposure? And if so, what are you buying?
I'm not smart enough to figure out crypto. I'm playing it just very weakly, timidly, meekly. I'm sorry. I'm got enough problems with my day job. I can't figure out crypto, not yet.
So Mark, then, if it's a no for crypto, curious, as you're looking at the markets, what do you see as some of the biggest risks to equities, not just in the longer term, but also in the short term?
Well, I think that inflation, I mean, this is look, in the middle of NASDAQ peaked in the middle of February this year and didn't get into a bear market after that, but came close. It fell off as much as 9%. And it was entirely due to rising inflation rate risks. So that's one of the biggest issues out there. And then regulation too, especially in the Biden administration. The Trump administration was tough on big tech. The Biden administration is tough on big tech. Everybody seems to be tough on big tech, and probably for good reasons. These are very powerful, large platforms that need to be very closely monitored. But anyway, that's the regulatory risk. Are they going to be forced to divest assets? Are they going to are some of their tax policies going to be aggressively changed, or forced to moderate, et cetera? So those are the two biggest risks I can think of across equities now, but particularly across technology. It's rising interest rates and it's greater regulation.
I want to ask you about small cap stocks. We're seeing them start to come back to life a little bit. Are you exposed there? And what's your outlook, especially as we're going to be heading towards earnings season pretty soon?
Well, there's a couple of small cap internet tech stocks that we particularly like. There's this company Wix out of Israel. Now, there's a lot of geopolitical risk out of an Israeli company these days, but very good innovative company in the web presence space. We like this company, GoodRx, which is a U.S. online, not a drug retailer or a pharmacy retailer, but it's a great comparison shopping tool for consumers and a way for pharmaceutical manufacturers to advertise to consumers. So that's a second name that we like. And then a real contrarian call of ours is Stitch Fix, which has been an extremely volatile stock, but one we think that's way oversold, and we like it as a business long term. It's kind of a subscription fashion business. So those are the three small cap stocks that we like.
All right. Mark Mahaney, Senior Managing Director, Head of Internet Research at Evercore ISI. Thanks so much for joining us today.
Here's a Foot Locker up almost 2% right now. We bring into the stream Brian Cheung as a special guest who can explain why the sneakers fit so well. Brian?
All right, thanks so much, Adam. Yeah, joining us right now is Foot Locker CEO Dick Johnson. Dick, good to speak with you again. And part of the reason why the stock is up, I suspect, would be off of the quarter you just announced on Friday. It's not very often you see same-store sales up 80.3% in the most recent quarter. How would you grade the momentum in your business right now?
Brian, we had a tremendous quarter. It's hard to compare against 2020, given the COVID closures, and we were just starting to open doors back up. But when we go back to 19 and see that we were up against that as well, I think our team had a great quarter. The product was hot. There was certainly stimulus money in the marketplace. We saw the ports free up a little bit, and we saw our vendor partners able to ship product to us quicker, more expedited methods. So everything that we saw was a positive, and clearly the customer has a lot of desire for the great product in our segment right now.
What do you think is the biggest driver of the business right now? Is it still consumers have those stimulus checks, or is it the likes of a Nike and a Puma just selling cool stuff?
Well, I think it's a combination, Brian. It always is, right? I mean, the consumer loves great product, and there's a lot of great product in the market right now from brands that you mentioned, and Adidas and VF with Vans. and we've got just some tremendous brand partners that continue to bring heat. So whenever our consumer has money in their pocket, they look to us. But even more importantly, right, the fresh kicks on their feet, the fresh T-shirt, the fresh fleece piece is very much a part of their uniform. So even as they start to go out and do more things with the economy opening back up, I truly believe that they'll be in our stores buying the great product that you referenced.
What's that post-pandemic footwear look?
Well, for our consumer, it's going to be sneakers, Brian, without a doubt. It's I've been an advocate. I'm hoping that even in your suit today that you're wearing sneakers, but I've been an advocate that sneakers are everyday sort of footwear, and our brands bring great looking stuff that's very athletic looking. They also bring some very casual looking things that fit in any scenario. So certainly for our core customer, it's going to be a pair of sneakers, a fresh T-shirt, and a fresh fleece piece to make their uniform complete as we get into the summer.
Dick, I'll take the veil off some of the TV magic here. I'm not wearing any sneakers right now, but if I was wearing, I'm sure I got them at Foot Locker. Some of the gains,
Good to hear.
Some of the gains that you saw in the first quarter, is that sustainable?
What, 80.3%? No, right? I mean, it can't be, right? We're up against door closures from a year ago, but the truth is the strength that the team put together in the first quarter, certainly we believe that there's product heat and the customer has a huge desire. So I think there is positive momentum behind the business, and we're certainly optimistic, right? We see as doors begin to open, as economies begin to open, we have even more upside to continue to deliver great product to our consumers.
One theme we're thinking about here at Yahoo Finance, Dick, is the great reopen. The fall is going to look very different for households. How do you think that will shape your business?
Well, we're going to have a real back to school season this year, right? Last year was sort of an abridged season with some kids going back to school, some kids in a hybrid learn from home sort of situation. We see the economy truly starting to open up. Will it be July 4th? Will it be closer to back to school in the fall? Not sure, but again, our consumer loves a fresh pair of kicks, right? They want the coolest product that they can possibly get. Our vendor partners continue to bring that to market, and we're going to serve our customers, whether that's digitally or in our stores. And one of the things with the great reopening that you referenced, Brian, is our consumer loves being in our stores, right? Even as we've started to see some of the capacity limits lift, we've seen more people out and about. We've seen, the mask requirements change a little bit. We've seen a lot of people in our doors. We've got stores still closed in Canada. We've got stores still closed in Europe, but across the U.S., we certainly are wide open at this point, and consumers are coming back into the stores in a big way.
We got news today, Dick, that New York City schools, they won't allow remote learning this fall. I mean, you take a step back, do you expect a sneaker buying boom for back to school?
Well, whether it happens specifically at back to school or we continue to see this momentum behind us, again, as great product comes into the marketplace, our consumer finds a way to buy it. So yeah, I think there really will be a back to school season this year, Brian, and that'll be different than last year. When kids were making and families were making the decision about do they go back to school, is it a hybrid, whatever, they will want to look fresh and new when they get to see people again, right? They haven't seen a lot of their friends for a while in some cases. So their ability to have great products on their feet, fresh new fleece piece, new T-shirt, whatever it happens to be, those are great opportunities for them to look really great when they get back into the school environment.
Are you getting enough inventory to support what you're seeing in the business in the latter half of this year? And I ask that, inventory coming out of in the first quarter, it was down 30% year over year.
Yeah, it was. And yet we were able to have a great quarter, right? So again, the inventory that comes in turns, and we've been, I talked a little bit about the slowdown at the ports. We've sort of been through that now, right? The ports are, still backed up. We know that there's still container vessels at anchor. But again, it depends on where our product is in the process. And we continue to see our receipt number and our sales number and our inventory number getting more in line. We ended our last fiscal year and the first quarter inventory down between, in the 30% range, as you mentioned. But we continue to see the order book look good and great quality products coming through day in and day out.
Why did you make the decision to shutter Foot Action?
Well, Brian, we constantly do a portfolio review, right? This is an ongoing process. If you go back in 2020, We actually shut down the Runners Point banner in Germany after we had done a look at the productivity and the profitability by banner. We do this on an ongoing basis. We've talked for many quarters about the flexibility that we've built into our lease portfolio. And as we look forward and see where those expiration dates are on a lot of the foot action banner stores, now's the time to make the move. So again, we see, that we'll be able to drive where we transition stores to a Foot Locker and a Champs, we'll be able to drive productivity. We've got the flexibility in the leases, and we know that it's a strengthening of our portfolio in total going forward.
How many of those stores, the Foot Action stores, how many of those stores will become Foot Locker?
Well, we're going through the portfolio review in detail. We will see probably a third of those stores become either a Foot Locker or Champs or Kids Foot Locker, depending on where they're located, the right size, et cetera. We've got lease expirations on about 40% of them that we'll be able to affect, and we're reviewing that remaining 25-ish sort of percent to see what the best use of that property is.
All right, we'll leave it there. Foot Locker CEO Dick Johnson, always good to see you. Stay safe. Hopefully we'll get to do this in person this year.